When it comes to trading in the Forex market, one of the most crucial and often misunderstood concepts is risk exposure. Risk exposure refers to the amount of capital a trader is willing to risk on a single trade or in the market as a whole. Properly managing this exposure is essential for the long-term survival and success of any trader, as risk is inherent to the very nature of financial markets. Risk exposure is directly related to the amount of money you're putting at stake in a trade. In Forex, this risk is measured in terms of the percentage of your account that you're willing to lose on a single trade. For example, if your trading account has $10,000 and you decide to risk 2% on a single trade, that means you're willing to lose up to $200 on that trade. The level of risk exposure you determine should align with your personal risk tolerance and your overall trading strategy. Risk isn't only related to the size of the position. Market factors also play a role. Unpredictable moves in currency. Pairs, the impact of economic news and political events can significantly increase risk exposure. For example, during a major announcement, such as an interest rate decision by a central bank, market volatility can increase quickly, causing large movements in currency prices. A trader who hasn't properly managed their exposure could see their capital affected dramatically in a split second. To manage risk exposure, traders use a variety of tools and techniques. One of the most important methods is the stop loss. A stop loss is an order placed to limit the losses on a trade. If the price moves against the trade by a certain amount, the stop loss automatically closes the position, preventing further losses. This is a vital tool for limiting risk exposure and protecting the trader's capital. Another important aspect is position sizing. Determining the right size for each trade is critical to managing risk exposure. If you choose to trade a position size that's too large for your account, you could easily put a significant portion of your capital at risk. Responsible traders carefully calculate their position size based on their account balance and the level of risk they're willing to take. There are several risk management formulas and calculators available to help determine the optimal size for each trade. In addition to these methods, capital management is another way to control risk exposure. Setting a maximum percentage of capital to risk on each trade is a common practice. Many traders recommend not risking more than 1 to 2% of your total capital on any single trade. This ensures that even if one trade results in a loss, it won't drastically affect your account balance, leaving you with enough opportunities to recover. In conclusion, risk exposure is a key concept in Forex trading. It's essential to understand how much capital you're willing to risk and then implement risk management strategies to protect it. Using tools like stop loss, calculating position size correctly, and practicing capital management are fundamental steps to ensure that your risk is under control. No matter how experienced you are, risk exposure must always be managed with discipline in order to achieve long-term success. If you enjoyed this video, don't forget to follow our channel for more content on Forex and trading strategies. Give us, like if this information was useful, share it with someone who could benefit, and leave a comment with any topics or concepts you'd like us to cover in future videos.